information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Andy Duncan, keeping you up to date with expert opinion on precious metals and the markets.
Today I'm speaking to James Turk, chairman of Gold Money and co-author of The Collapse of the Dollar and How to Profit from It. Good morning, James.
Morning, Andy.
A month ago on King World News, you claimed that approximately 15,000 tonnes of gold has disappeared from around a total of 32,000 tonnes declared on the books of Western central banks because they're conflating physical gold holdings with paper IOUs for lent-out gold receivables. You said this had been done to suppress the gold price against fiat currencies. Now, after a month of reflection and listening to other people and the debate that you sparked with these comments, do you still hold the same view?
Yeah, absolutely I do. This is not a new debate. In the King World News interview, I was referring to works that I had done back in the early part of the decade, 2000, 2001, 2002. So it's not new news that the gold price is being manipulated. What is new news is that more and more people have accepted the fact that the gold price is manipulated within the gold industry. 10 years ago, a few people accepted it. Now I think everybody who understands gold does accept it. And I guess importantly, the next stage will be, will the general public finally come to understand that the gold price is being manipulated, and that gold remains good value, and that it's going to ultimately go a lot higher because of the debasement of the national currencies that it's pursuing. Now, the interesting thing is we don't know whether the exact number is 15,000 tons, 12,000 tons, 20,000 tons, because there is no accurate accounting from central banks. But there's no doubt that a lot of central bank gold is missing.
You've got a couple of indexes which are based on central bank gold reserves, the main one being the Gold Money Index, which when I last saw that showed a fair value for gold at $11,000. Now, if we divide the central bank foreign reserves by what you think central bank gold reserves are, what do you think the fair value for gold is now?
Yeah, that's really a good question. Both on the Gold Money Index as well as the Fear Index, I just assume that the central bank reports are accurate and that the gold they say they own is actually there in the vault, when in fact we know that a lot of that gold has been removed from the vault and loaned to various participants, fabricated and shipped around the world in form of, coins, bars, and high-carat jewelry. Obviously, given the fact that, that's the denominator in the equation, it's an important part of the equation, that if the gold isn't really there, the gold price ultimately would be much higher. In other words, if there's only half the gold, then instead of 11,000, it would be, 22,000. But regardless, Andy, whether it's going to 8,000, 11,000, 22,000, the major thing is that currencies are losing value, and that gold has a long way to go in this bull market, just like it did back in the 1970s. It all went much further than what most people expected. It's going to be the same thing this time around as well.
With your Fear Index, which is the US gold reserve figure multiplied by the gold dollar price divided by the total M3 figure of dollars, that indicates when it goes up that there's greater fear in the market. Since your comments a month ago, has the Fear Index gone up?
Yeah, it moves slowly. And it reflects the fact that, the gold price has been rising and consequently fear is rising and the fear index is going up. It is in a major uptrend. It has been since about 2002 when it flashed a buy signal. And it's an indication or an index that they use to show the long-term trends. It's not something that's used for short-term trading, but shows you, firstly, when gold is undervalued, or ultimately the other side of the equation when it becomes overvalued, and also, what the trend is. And since 2002, the trend has been up, and it's been gold is moving from undervalued, but interestingly, it still remains undervalued. The Fear Index is just over 3%. In 1980, it was 10%. During the Great Depression, it was 30%. So if things were to become as bad as the Great Depression, just by looking at it logically, 3% to 30% means a tenfold increase in the gold price from here. So, again, we're still a long way to go in this bull market, and you can't really be more specific as to, where we're going to end up. But as long as central banks remain on this path of debasement of the local currencies or the national currencies that they're managing, that ultimately means a much higher gold price.
Now, you said that when the general public get onto gold manipulation and gold debasement, we'll move into the third stage of the bull market. With your fear index, you might not have a time frame for that, but do you have a fear index number that you think will indicate that we've moved into the third stage?
Well, it's hard to say. I think the fear index in this move is going to go above 10%, which was the level that was reached in January 1980, the last time that the bull market peaked out. But, historically, the fear index should probably be, much higher. And what the fear index, in effect, is measuring is, the fractional reserve banking system. How much paper is out there backed by how much gold. And historically, 40% was what the Bank of England originally followed as the policy. In other words, for every 100 pounds that were out there, 40% was backed by gold in the Bank of England, and the other 60 was paper. When Sir Isaac Newton invented the classical gold standard back in 1700, he created certain rules for operating, and the prudent rule that was created for the Bank of England was that the gold reserve should be 40%, which is in effect, what the fear index is. So we've got a long way to go in the fear index, and it's hard to say, how high it's going to go. But, it could go to, 100% effectively, meaning that nobody wants to transact in dollars if the dollar does indeed collapse, just like, the Weimar Republic, Reichsmark, and all of the other currencies that have collapsed over the last 100 years because of central bank mismanagement.
Now, with the German gold, which is stored in the Bank of England and the Federal Bank of New York and the Bank of France, you think that some of it's been taken to Switzerland and fabricated and then sold out to serious investors who've taken it to who knows where around the world. At some point, the central banks are going to have to stop doing this, aren't they? They're going to have to stop lending out money. They're going to hit a golden cliff and just either run out of gold or decide to stop giving out the gold that they have. How close do you think we are to that day?
Yeah, that's really a good question. And actually, a golden cliff is really a good description of, what is about to happen. I think we're actually getting very, very close. I say this for a couple of reasons. There was a gold study that Frank Venerosa did back in the late 1990s. And, he had sort of indicated that central banks are going to be running out of gold in about 10 years or so. And we sort of, gone past that, but, we haven't gone that much past it. And you see that the gold price is rising more rapidly now than it had been earlier in the decade. And I suppose the other thing, too, is that the anecdotal evidence is, suggesting that we're very close. Back in the late 1960s, there was a movement globally to what was called dematerialized gold. There was supposedly not enough gold around, at least that's what they said, and they created SDRs, these special drawing rights of the International Monetary Fund, which they called paper gold. The problem back in the late 1960s wasn't that there was too little gold, it was that there was too much paper currency. Now, I was talking about this just recently on a King World News interview, that India has announced that they want to dematerialize gold in India. And this is significant because India is one of the largest importers of gold and buyers of gold, year after year. So the fact that they're again talking about dematerializing gold, even this is in the case of India as opposed to some kind of global effort, it suggests that, we're pretty much close to the end game. And it also ties in with my long-term forecast that, this financial bust and bull market in gold, we're going to, possibly conclude sometimes between 2013 and 2015. And clearly the dollar is headed for the cliff. I like to say that we went over the fiscal cliff, or the U.S. went over the fiscal cliff in 1971. And over these past few decades, we've been falling over the cliff and we've not yet landed. The moment we land is when the dollar collapses. But when we went over the fiscal cliff, or the reason why we went over the fiscal cliff, is because in 1971, gold was removed from the system. And when you remove gold from the system, you're removing all of the discipline. And when you remove the discipline, governments just keep borrowing and creating money out of thin air. And, since 1971, there have been something like 30 increases in the debt ceiling in the United States. And this just goes to show that there is no discipline. And when there is no discipline, ultimately the currency is hyperinflated and destroyed. And I think that's where the US dollar is headed.
I'll have to change my analogy from a golden cliff to a golden beach. So when When the dollar hits this golden beach, I think they'll try to introduce the SDR again. Do you think they'll try to bring the SDR in, or will they be forced to use a gold-backed kind of money?
Yeah, the currency system will be reconstructed. There's no doubt about that. My hope is that governments will get out of the currency and money business and allow private industry to and the market. Let the free market forces deal with it. Governments have trouble delivering the mail. How can we expect central planners sitting in some central bank to manage the economy? We saw how the Soviet Union failed, and including the Russian ruble. The U.S. is no different. It's just a question of when the Politburo and the Federal Reserve, finally throws in the towel and says that it can no longer be managed. But when it is reconstructed, I'm hopeful that we go back to the principles of what the framers of the Constitution, established. The first currency of America was the Continental, and it collapsed because of hyperinflation and after the War of Independence. And one of the reasons the framers created a more perfect union was to create a common market with a common currency. It's what like Europe tried to do. But the framers went one step further. They also created a common defense. But the common market and the common currency was created by the Constitution, and the currency was, of course, the dollar, which was mentioned in the Constitution and was one of the first acts of Congress signed by George Washington, was the Coinage Act of 1792, which defined exactly what a dollar was, which was a specific weight of silver. And the silver remained the standard until 1900, when the American government officially went to a gold standard. But the point is that that's what government's monetary policy should be. It's to maintain a specific weight of gold as a unit of account. And, clearly governments have failed in that regard. So I'm hopeful that, private industry in the future will provide the currency, just like private industry can better deliver the post and packages. We've got FedEx and UPS in the U.S., and there are a lot of other courier companies delivering packages better than the U.S. Post Office. The same thing applies to money. The same thing basically applies to any service. It's always much better when it's left to the free market, because the people who run the businesses that deliver these services in the free market are driven by the bottom line. The people who run services for the government have no bottom line accountability. They're not worried about profit and loss. Look at the post office, which has been running billions of dollars of losses for year after year after year. But government things are run by politics, not by profits. And, that's not the way to provide goods and services. So I'm hopeful that, when the dollar does collapse, that there'll be a wake-up call in the States. And we'll go back to basics. But, time will tell whether that's the way they go or whether they go the wrong way, which is, more chaos after a currency collapse.
Well, 33 years after 1900, the United States government confiscated all the gold in the United States when their game was up in 1933. Is there a chance of them doing the same thing to restart the game, or has the gold just simply disappeared?
That's a good question. First, it's actually two different questions. Will there be another confiscation, and really how much gold is in Fort Knox? I think it's very possible there could be another confiscation. There already has been one. So, why couldn't there be two? It's more likely, though, that they'll impose various capital controls trying to keep the system working. And one that I've been talking about for some time is that they'll create two different dollars, a domestic dollar and an international dollar. So everybody who holds dollars outside the United States, they'll only be able to take those international dollars and spend them in the U.S. with Federal Reserve approval or, Treasury approval. What that will mean is that the international dollar will fall to a huge discount against the domestic dollar, because you're cutting out the opportunity to spend those international dollars. And from the U.S. government's point of view, that'll relieve its debt obligations by the amount of the discount. Obviously, foreign holders of dollars like the Chinese and everybody else aren't going to be too happy if that's the way they go. But, Secretary Connolly, who is Treasury Secretary Connolly, who is Nixon's Treasury Secretary back in the early 1970s, made U.S. policy clear, which is still the case. Speaking to the world, he said the dollar is our currency, but it's your problem. And that continues to be the approach that the U.S. government has taken. Even though it has a clear responsibility to the global community to maintain the purchasing power of the dollar, because it is the world's reserve currency, the U.S. government has clearly failed on that responsibility. And that's going to have consequences in the future, not only domestically, but also internationally.
It might be a case of force majeure where they just do whatever it takes to survive. Getting on to the second question then about Fort Knox. How much gold do you think is in Fort Knox?
Yeah, that's really the important question. We don't really know for certain, because everybody knows there's been no independent audit of this for decades. And, I have a suspicion that a lot of that gold has been taken out, either swapped or leased, loaned, or whatever. But I really do question whether that amount of gold is there or not. But, it brings up a related point, Andy. Back in the 1930s, Roosevelt justified the confiscation of gold because he said he needed the gold in order to have more gold in Fort Knox when the dollar was devalued. But really, it's really just a math issue. You can have less gold and just devalue the dollar further. In other words, back in the 1930s, Roosevelt devalued the dollar from $20.67 to $35, and then he confiscated gold. But very little gold was actually turned in. It was only about 20% of the gold that was in circulation at the time. And the reality is that if he had only devalued the dollar to $36 instead of $35 or thereabouts, it would have the same impact. It would have given the dollar value of the gold in the reserve the same impact as if without the actual confiscation. So the point I'm making is that it's just a question of how devalued the dollar is going to be against gold, or to look at the other side of the coin, how high the gold price is going to rise. We really don't know. We just have to see how this plays out, and what government does between now and the final nail goes in the coffin for the U.S. dollar. And that's still a year or two, or maybe a month or two. You can't really predict these things, but we're still on that road that the dollar is ultimately going to be hyperinflated, and we just have to take it, day by day, week by week, month by month. And in that kind of an environment, the best policy to pursue is just continue to every month, save gold or save silver. It doesn't make sense to save paper currencies or national currencies anymore because the interest rates are so low and the inflation rates are so high. The only way to save money for the future is to accumulate gold and to accumulate silver. And, I've been recommending that policy for over a decade, and I continue to recommend it because we're still on the same road with regard to currency debasement. And as a consequence, the price of gold and silver are going to continue to climb.
Finally, before we finish, before that final nail goes in, is there anything else private investors should be doing except accumulating gold to prepare for that day?
Well, the general rule of thumb is that when you're in a financial bust, and that's what we've been in since 2000, of different and varying degrees, but, it's basically a financial bust. You want to avoid financial assets and own tangible assets, but you only want to own tangible assets that make sense. Things that are undervalued. Houses in the south of Spain is not necessarily a tangible asset that makes sense because they're overvalued given the fact that you had the housing bubble and prices haven't really come back down to realistic levels. But tangible assets that make sense are ones that are undervalued, like precious metals. I think farmland is still basically undervalued. Things like timberland is still undervalued. I think oil is still undervalued, and indeed, most commodities are still undervalued, in my view, compared to where they're going to be a couple of years down the road. But I think the rule of thumb is just avoid financial assets and focus on tangible assets until this financial bust is over. As they say, it's not over until it's over, and we don't know when that's going to be, but I think it's still some point in time yet in the future.
Thank you for your time today, James Turk.
Thank you, Andy.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.